Welcome to vTalkInsight, Market Drivers Daily for May 13th, 2026. Three forces are colliding today: a high-stakes U.S.-China summit, an AI capital boom that continues to lead equities, and a fresh inflation shock that is pushing Treasury yields back towards cycle highs. Let's begin with the geopolitical backdrop and what it could mean for risk assets. Geopolitics remains the macro anchor, but today the tone is more managed risk than outright crisis. The U.S. president is in China with a heavyweight CEO delegation, and both sides are signaling a desire to prioritize trade stability over confrontation, even as tensions on issues like Taiwan and technology remain elevated. For markets, that combination suggests a base case of continued détente and incremental deals, with sizable tail risks still lurking in the background. Expectations for this summit are deliberately low on structural breakthroughs and high on symbolic progress. Analysts see the most likely outcomes as extensions of the existing tariff truce and earmarked purchase commitments, particularly in agriculture, energy, and potentially a large aircraft order that would matter for Boeing and related supply chains. Semiconductors and AI are central but contentious. The presence of NVIDIA's chief executive on the U.S. delegation has boosted chip sentiment, yet most observers still expect only marginal movement on export controls rather than a fundamental reset. Beneath the headline photo opportunities, chips and critical materials are the real bargaining chips. The U.S. continues to restrict advanced AI semiconductors, while China is pushing to secure access to NVIDIA hardware, at the same time accelerate domestic alternatives and leverage its position in rare earths. That dynamic keeps technology supply chains and defense sectors highly exposed to policy surprises, even if the summit produces short-term positive headlines for equities. At the same time, the Iran conflict and the effective blockade around the Strait of Hormuz are tightening the energy backdrop. Tanker traffic through the choke point is severely reduced. Satellite imagery shows no recent loadings at Iran's Karg Island terminal, and global oil inventories are drawing at a record pace, even as prices themselves have not yet spiked to prior crisis highs. That gap between physical tightness and relatively contained prices is being bridged by large strategic stockpiles in the U.S. and China. But the longer disruptions persist, the more vulnerable the market becomes to a sharp repricing. Corporate commentary underscores how uncertainty is weighing on real activity. European industrial groups cite delayed orders linked to Middle East risks. Shippers like Hapag-Lloyd face hundreds of millions in extra fuel costs, and freight rates are rising as vessels reroute, all pointing to margin pressure outside the energy complex. Policymakers are also weighing energy tools, from potential U.S. requests that China release crude from its vast reserves, to domestic debates over refined product export bans that could dramatically increase global price volatility if enacted. In the near term, the key signposts are the wording around Taiwan and semiconductor controls in the summit communique, any concrete aircraft or commodity purchase agreements, and fresh evidence on Hormuz flows and inventory trends. Together, they will shape whether today's calm risk appetite can coexist with an embedded geopolitical risk premium, or whether focus swings back quickly to Iran and a more defensive stance across assets. Artificial intelligence is still the main growth and earnings engine in public markets, but the narrative has clearly become two-way. On one side, AI-related stocks and indices keep printing record highs, powered by strong earnings, expanding margins, and an extraordinary wave of capital into compute infrastructure. On the other, leadership is narrow, valuations in some pockets are stretched, and policy and supply chain risks are becoming harder to ignore. The infrastructure build-out is accelerating. OpenAI's multi-year commitment to lease tens of billions of dollars of inference compute from Cerberus, combined with Cerberus' planned listing at a valuation approaching $50 billion, underlines how demand is shifting from general-purpose GPUs towards specialized inference hardware optimized for real-time workloads. At the same time, companies like Marathon Digital are pivoting from crypto mining to AI data center leasing, with over a gigawatt of energized capacity becoming a scarce asset as power availability, not just chips, emerges as the binding constraint for hyperscalers. Capital markets are leaning hard into this theme. Investor appetite for AI-related IPOs is exceptionally strong, with issuers increasingly preferring public listings over trade sales to capture high valuations and fund rapid expansion. In private markets, funding for leading foundation model players is moving into uncharted territory, with mooted raises in the tens of billions of dollars at valuations comparable to, or even exceeding, established Chinese tech giants. SoftBank's earnings, driven largely by mark-to-market gains on OpenAI, further illustrate how AI has become a dominant driver of returns for large investment platforms. That strength comes with concentration risk. Index gains are heavily skewed toward a narrow cohort of AI and semiconductor names. Options markets show record call buying and sharply steeper volatility skew, and forward earnings multiples for AI leaders and the broader Nasdaq are sitting in the mid-30s, well above long-run averages. Some participants argue the current setup is more grounded than past bubbles, pointing to rapid and tangible revenue growth, rising earnings estimates, and multi-year capex visibility out to 2028. Yet others highlight that over-ordering in chips, any spike in yields, or tighter AI regulation could quickly flip today's enthusiasm into an abrupt drawdown. Importantly, AI is no longer just a market story. It is changing corporate behavior and macro feedback loops. Global consumer brands are rolling out generative AI in marketing, pricing, and workflow automation, with campaigns receiving positive customer responses and AI line items now discussed at the chief financial officer and board level. The wealth effect from AI-driven equity and private valuations is supporting upper-income consumption and investment spending, potentially offsetting traditional disinflationary channels and, in an upside growth scenario, even forcing central banks to lean more hawkish if demand stays strong. Looking ahead, watch how Cerberus trades after listing, whether mega funding rounds for key model providers clear at whispered valuations, any escalation in Samsung's labor dispute that could constrain memory supply, and signals from U.S.-China talks on chip exports. Together, they will shape whether AI remains a controlled growth engine or evolves into a more unstable source of market volatility. The third pillar today is inflation, where the story has swung back toward persistence. Recent consumer price reports have come in hotter than expected, and April producer prices have just delivered the largest monthly gain since 2022, with headline PPI rising around 1.5% month-on-month and roughly 6% year-on-year. These upside surprises follow earlier energy-driven jumps in headline and core inflation, with some gauges of CPI and PPI cited in the high single digits, all far above the Federal Reserve's target. Bond markets have responded quickly. Two-year Treasury yields are now above 4%. The 10-year is approaching 4.5%, and the 30-year has cleared the 5% threshold, with the latest long bond auction clearing at levels not seen since before the global financial crisis. Inflation swaps are no longer pricing consumer inflation back below 3% by year-end, and some curves now imply readings closer to 4%, effectively removing near-term rate cut expectations and reviving debate about whether the next move could even be a hike. Energy and supply chains are key transmission channels. Gasoline prices have jumped sharply, diesel and jet fuel costs are squeezing transport and logistics, and shipping companies are paying significantly more for rerouted voyages around the Gulf and Red Sea. Those pressures are feeding into air freight, warehousing, and food, while retailers and consumer goods companies, having run down inventories and absorbed earlier cost increases, are increasingly passing higher input prices on households. That raises the risk that inflation becomes more entrenched in services and everyday goods rather than remaining a narrow energy shock. At the macro level, the picture is still mixed. Strong retail sales and a robust labor market are supporting overall growth, and AI-driven sectors are generating high margins and capex that underpin parts of the earnings outlook. However, rising input costs, tariffs, and wage pressures are challenging corporate margins in more traditional sectors, while higher fuel prices are already disrupting smaller trucking operators and raising concerns about consumer sentiment, especially with politically sensitive gasoline levels ahead of the U.S. election. That tension keeps a stagflation risk scenario on the table, even as the baseline remains one of continued expansion with higher for longer rates. Across assets, the result is a widening gap between an AI-powered equity narrative and a bond market that is firmly focused on inflation risk. Early trading shows equity futures under pressure outside a handful of large chip names, while flows into front-end and inflation-linked bonds remain strong as investors look to lock in higher nominal and real yields. The critical watch points from here are incoming price data and how central banks frame the trade-off between persistent inflation and still solid growth. US PCE, subsequent CPI and PPI releases, Euro area growth numbers, and the next International Energy Agency and OPEC reports on supply will all shape whether yields rise in an orderly fashion or deliver another yield shock that forces a broader reassessment of risk assets. To sum up, geopolitics is offering a fragile window of stability as the U.S. and China prioritize trade gestures over confrontation, even while Middle East tensions keep an embedded risk premium in energy and freight. AI remains the dominant engine of equity leadership and capital formation, with infrastructure demand, IPOs, and private funding all signaling a multi-year build-out, but leadership is narrow in valuations and positioning leave room for sharp two-way moves. Meanwhile, inflation data are re-accelerating, pushing Treasury yields towards cycle highs and shifting the policy debate back toward higher for longer, with energy and supply chains driving second-round effects into the broader economy. For portfolios that mix points to elevated cross-asset volatility and a growing divergence between AI-led growth stories and rate-sensitive segments, making data and policy communication in the coming weeks especially important to watch. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.